Welcome to the deep dive. Today, we're really getting into the weeds on, well, the money side of AI, the financial engineering that's basically fueling this whole trillion-dollar explosion.
That's right. We've gathered a lot of material um, looking at this really intense point where cutting-edge tech meets high-stakes finance.
Yeah, and it all boils down to this one big question, maybe the question for the next decade.
Yeah.
Are we actually building the foundation for this promised age of abundance, Or is this whole thing just inflating into a massive, super leveraged financial bubble?
It's interesting, that phrase, age of abundance. It sounds amazing, almost, well, prophetic, doesn't it? Infinite possibilities.
Right.
But the story behind it, the how, is way less glamorous. It's about really complex, sometimes almost dizzying financial structures needed to make that vision real, turn it into actual silicon and server.
And the money involved now.
Yeah.
It's staggering, but it's not just the amount, it's how it's being funded, the structure. That's what we need to deep dive into today.
Exactly, because you have to ask, is this real organic market demand driving things, like actual customers paying cash for actual services?
Yeah.
Or is a lot of this growth kind of financially manufactured? We need to look past the latest cool large language model and understand the financial physics underneath, which, frankly, getting pretty peculiar.
Absolutely. And the thing that really brought this all into sharp focus, the deal that had analysts just buzzing, happened recently, October 6, 2025, the huge OpenAI AMD circular financing deal.
Oh yeah, that one definitely turned heads.
It's not just OpenAI buying chip, it's like a template for how this whole AI economy seems to be working now. So our mission today,
Yeah.
break down this specific deal, put it in context with all the other circular investments popping up everywhere, and really try to figure out, is this smart infrastructure building, or is it bubble 2.0, .com style?
A necessary deep dive for sure. The stakes are just enormous.
Okay, let's unpack this deal then, because it really does feel like the ultimate gamble in this whole chip war. So, ground zero, the OpenAI AMD mega deal itself. The first thing that hits you is just the sheer size. It's unlike any tech deal we've seen before, really.
Right. OpenAI committed to buying, what was it, hundreds of thousands of AMD's Instinct AI accelerators. Over the next few years. That's not a small order.
Hundreds of thousands, and it's tied to this physical build-out goal that's just mind-blowing.
Yeah, the sources say this compute is meant to power up to 6 gigawatts of new data center capacity. 6 gigawatts.
Put that in perspective for us. 6 gigawatts is...
It's enormous. Think about the giant cloud data centers run by Microsoft or Google. 6 gigawatts is like multiple of those combined, maybe even rivals the entire current footprint of some hyperscalers.
Wow. Go
So this
bigger.
isn't just OpenAI getting chips. This is AMD making a massive direct play against Nvidia's dominance. They're locking in arguably the most important AI customer for years.
But getting the chips is only half of it, isn't it? The really weird part, the controversial bit, is what AMD gave back.
Exactly. This wasn't just, here's cash, give us chips.
No, AMD issued OpenAI warrants. Warrants for up to 160 million shares of AMD stock.
Let that sink in. 160 million shares, that's roughly 10% of AMD's total common stock.
10%?
So suddenly, OpenAI isn't just a customer. They're potentially a massive shareholder in their supplier. It
Yeah.
completely changes the dynamic.
And the price for these warrants, it's almost nothing, right?
Nominally, yeah. Just 1 cent per share. That's the key.
1 cent.
That tiny price is what makes the whole potential upside so explosive for OpenAI. It gives them this incredibly cheap, highly leveraged way to get a huge equity stake in AMD.
Of course, for AMD shareholders, that's a lot of potential dilution down the line.
It is. That's the trade-off. AMD gets this guaranteed multi-billion-dollar demand locked in, which helps their expansion plans and lets them really challenge Nvidia head-on. But the price is potentially giving away a big slice of the company's future value.
And OpenAI doesn't just get this potential jackpot immediately, right? The warrants have strings attached.
Correct. They don't vest all at once. The vesting is tied specifically to deployment milestones. It starts when OpenAI actually deploys the first gigawatt of that compute capacity.
Okay, so they have to build it first.
You have to build it. They need to show they're actually using the chips, building the infrastructure before they can cash in, so to speak, on AMD stock potentially going up.
And that link, the equity gain tied to the physical build-out, that's what got analysts really talking.
That's exactly it. The risk symmetry, the financial circularity, it's pretty unprecedented on this scale. OpenAI now has this massive incentive, not just to use AMD chips, but to see AMD's stock price go up.
Because their warrants become more valuable.
Precisely. It's AMD's biggest, boldest move against Nvidia yet. And they paid for it, essentially, with a big chunk of potential future equity.
Okay, so let's follow the money here. Let's really zoom in on this circular dynamic because it seems to explain these crazy valuation spikes we're seeing everywhere in AI.
It does. It's this self-reinforcing cycle, a feedback loop. Understanding the three phases is, like, absolutely key to understanding the whole AI money game right now.
All right, phase one, it starts with OpenAI's commitment, right?
Yep. OpenAI commits to buying all those hundreds of thousands of AMD chips. That huge demand instantly makes AMD's sales forecasts look amazing.
And the stock market loves that.
The market loves guaranteed long-term revenue. So AMD's stock valuation gets a big boost almost immediately. That's phase one. OpenAI's demand drives up AMD's value
Okay, then phase two kicks in.
automatically. Because AMD's stock price is rising, those warrants AMG gave OpenAI, that potential 10% stake, suddenly become way more valuable, on paper at least.
Even though they only cost OpenAI 1 cent each.
Exactly. That tiny investment potentially turns into this massive paper windfall for OpenAI, sitting there as an asset on their books.
And phase three is where the loop closes. This is where it gets really interesting.
This is the kicker. Theoretically, OpenAI can then use those paper gains, maybe monetize them somehow, use them as collateral, or leverage them too. Guess what?
Fund buying more chips from AMD.
Exactly. Fueling AMD's growth even further.
Yeah.
It's this, like, perfectly designed closed loop. Customer success financially feeds supplier success, which helps the customer again. And notice, no new external cash really had to come into that specific loop right away.
Yeah, it feeds itself.
And we saw this happen in real time. Right after the deal was announced, AMD shares shot up, what was it, over 30% in just 2 days.
30%, that's huge.
It briefly added something like $80 billion to AMD's market cap.
$80 billion in 48 hours, just like that.
And boom. Instantly, OpenAI's warrants, even though they hadn't vested yet, were potentially worth several $billion on paper. That's the feedback loop in action, turbocharging the numbers.
Okay, so this sounds great for alignment. Both companies are totally incentivized to get those gigawatts deployed fast.
Totally aligned. They both want it built yesterday. But, and this is a big but, it also massively increases the downside risk. It creates what the sources are calling volatility symmetry.
Volatility symmetry. Explain that. It sounds technical.
Think of it like tying two speedboats together with a really short rope.
Okay.
They move fast together, sure. But if one boat hits a big wave or, its engine stalls.
The other one gets yanked around violently or dragged down.
Precisely. If something slows down OpenAI, maybe their next model isn't a hit. Maybe enterprise adoption is slower than hoped. Maybe regulators step in anything that hurts OpenAI's perceived value or ability to deploy.
Then AMD's stock could plummet, right, because that huge guaranteed demand suddenly looks shaky.
Exactly. And if AMD's stock plummets, what happens to OpenAI's warrants?
Their value evaporates, wipes out the paper gains.
Wipes them out. And it also makes it harder for OpenAI to raise more funds or use those warrants for future chip buys. It creates this potential feedback spiral of contraction.
So the success of one is totally locked to the success of the other, for better or worse.
Inextricably linked. It makes the whole system incredibly sensitive. Highly leveraged, you could say. Systemic risk baked right in.
And the scary thing, reading through the sources, is that this AMD OpenAI deal isn't some weird one-off. This circular structure, it's everywhere now. It's becoming the norm.
It really is. Circular investments are just multiplying across the whole AI sector. Chip makers, cloud providers, the big AI labs, they're all doing deals like this.
It's like the standard operating procedure for building out this AI industrial complex.
Yeah, the basic pattern is company A invests in company B, maybe with equity, maybe warrants, maybe credit.
And in return, Company B commits to massive, often exclusive purchases from Company A, chips, cloud compute, whatever.
So it looks like infrastructure build-out, but it's being funded by this kind of internal equity trading and reciprocal commitments.
Okay, we need to map this out. Let's trace the money through the ecosystem. Can you walk us through some of the other key circular deals just to see how widespread this is?
Sure. Let's start with the biggest fish, Nvidia, the incumbent kingmaker here.
Yeah.
Just before the AMD deal, in September 2025, there was the huge OpenAI Nvidia deal.
Right. What were the terms there?
OpenAI committed to deploy Nvidia systems for up to 10 gigawatts of capacity, even bigger than the AMD commitment.
10 gigawatts. And what did Nvidia give back?
Nvidia is investing up to, wait for it, $100 billion in OpenAI.
Whoa. $100 billion. That's almost unbelievable.
It's a staggering number. And the loop there is crystal clear, right? OpenAI commits to buying Nvidia GPUs. Nvidia books that revenue, their valuation goes sky high. That makes Nvidia's stake in OpenAI incredibly valuable on paper. And that huge paper value gives Nvidia the justification or collateral to pump even more investment capital back into OpenAI.
So the money flows out from OpenAI as purchase revenue for Nvidia and then flows back from Nvidia as investment capital into OpenAI. Round and round it goes.
Textbook circularity. Then you got the really foundational one, Microsoft OpenAI.
That's been going on for a while, right?
Since 2019, Microsoft has put in over $13 billion. But it was never just a simple equity check.
No, OpenAI is tied to Azure, Microsoft's cloud.
Fundamentally bound. Azure is their primary exclusive cloud provider. So Microsoft's investment essentially comes back to them as revenue when OpenAI uses Azure Compute.
So Microsoft is the investor, the landlord, and the vendor. They put money in via equity and get it back via cloud usage fees. Clever.
Very clever. Okay, next cloud giant, Amazon. They did a big deal with Anthropic, a major OpenAI competitor.
Yeah, what's that structure?
Amazon gave Anthropic $8 billion in convertible notes. That's basically debt they can turn into equity later.
And Anthropic committed to?
Using AWS, Amazon's cloud, for its main compute needs, and also committing to use Amazon's own custom AI chips, Trainium.
Ah, so Amazon gets paid for the cloud usage and potentially gets a valuable equity stake later when the notes convert and they lock in a customer for their own chips. A double, maybe triple win for them.
Exactly. Secures a major AI player on AWS, boosts their own chip adoption. And guess who else did a deal with Anthropic?
Let me guess. Google.
Bingo. Google put in $4 billion for a stake in Anthropic, ensuring Anthropic also uses Google Cloud for at least some of its workload.
Same logic. Got to keep these big AI labs spending money on your cloud. Can't let Microsoft or Amazon get them all. And your equity stake grows as they spend.
It's a defensive necessity for the cloud providers.
Yeah.
Okay, back to Nvidia. They're not just dealing with OpenAI. They did a deal with xAI, that's Elon Musk's AI venture.
Right. What was that one?
Nvidia provided $2 billion in a mix of equity and debt. And the condition, xAI uses Nvidia GPUs for its huge Colossus II supercomputer project.
So Nvidia invests $2 billion.
And then xAI immediately turns around and uses that money, or money freed up by it, to buy Nvidia's own GPUs.
Nvidia basically pays itself. They invest, book the revenue from the sale generated by the investment, and their valuation goes up.
It's incredibly efficient for Nvidia. They profit from the investment and the sale their investment enabled. Almost instant revenue recognition.
Okay, what else? This network is getting dense.
There's the Nvidia CoreWeave relationship. CoreWeave is a specialized cloud company that basically just rents out massive amounts of Nvidia GPUs.
And Nvidia owns a piece of CoreWeave.
A significant stake, yes. And CoreWeave's customers, often AI labs, including sometimes OpenAI needing extra capacity.
So Nvidia profits from selling chips to CoreWeave and profits from its ownership stake in CoreWeave and benefits from the overall demand for its chips that CoreWeave serves.
Wow.
They're capturing value at multiple points in the chain. Financing, supply, rental market. It's pretty integrated.
Okay, one more. The sources mention a really complex one, a triad.
Ah, yes, the OpenAI, Oracle, Nvidia loop. This one's like a three-way dance.
How does that work?
Okay, follow this. OpenAI needs massive compute, but maybe wants some diversity beyond just Azure. So they commit to doing a lot of training on Oracle Cloud.
Okay, step one.
Step two, Oracle, to handle OpenAI's huge demands, needs a ton of high-end hardware. So Oracle becomes a massive customer for
Nvidia chips. Nvidia chips, exactly. Step three. Nvidia, seeing all this demand and the importance of OpenAI, invests directly in OpenAI.
So the money loops. Nvidia invests in OpenAI. Oracle buys chips from Nvidia, funded partly by OpenAI's business. OpenAI pays Oracle for cloud usage, using funds potentially influenced by Nvidia's investment.
It's a full, three-way financial circle designed for internal capital movement, risk sharing, or maybe risk hiding, depending on your perspective.
Looking at all these deals together, it really does echo that vendor financing stuff from the late 90s, doesn't it? Where companies like Lucent or Nortel basically loaned money to their customers just so the customers could buy their gear.
It has that same feel. Inflated revenues based on deals where the supplier is also funding the buyer. It masked the lack of real external demand back then.
Which brings us right to the definition. We need to nail this down. What is circular financing, formally?
Right. Let's define circular financing. It's basically when companies invest in each other or offer really big financial incentives like cheap equity or warrants. And those incentives are directly tied to reciprocal business deals, like, I'll invest in you if you promise to buy billions worth of my stuff.
And the result is it creates this illusion of organic market-driven growth.
Precisely. because the money or the value is just cycling between the players involved.
So in AI, how does that mechanic work specifically? You've got two flows.
Yeah, two main flows moving in opposite directions but pushing the same expansion story. Flow 1, the AI labs like OpenAI or Anthropic commit to spending billions, maybe prepaying on chips or cloud services.
Okay, that's the commitment to buy.
Flow 2, the chip makers like Nvidia or AMD or the cloud providers like Microsoft or Amazon grant equity warrants or maybe big credits back to those same AI labs they're selling to.
Investment flowing back to the buyer.
Right. And this is the critical, maybe problematic part. Both sides get to book growth. The chipmaker reports massive sales commitments, boosting their stock. The AI lab reports huge new assets on their balance sheet, either the value of the warrants, the cheap credit, or the infrastructure access they secured.
And this is the core issue. Where did the new money come from?
Exactly. Often, no significant external cash from real end-user customers paying for a finished AI service has actually entered that specific loop to validate it. The growth is generated internally between the big players.
The source is called this synthetic growth, capital just spinning around inside this closed system.
Let's break that down a bit more because the accounting is where it gets tricky. Say AMD makes that deal with OpenAI. OpenAI makes a firm, non-cancelable commitment to buy chips over years.
Okay.
Under accounting rules, AMD might be able to recognize a big chunk of that future revenue now, or at least report it as firmly committed backlog. Wall Street loves that. Stock goes up.
Right. And meanwhile, OpenAI gets those 1-cent warrants.
And because AMD's stock just surged, thanks to the deal they just made, the value of those warrants instantly balloons on paper. So OpenAI also looks richer, holding this valuable new asset.
So both companies look like they're booming based on a deal primarily between themselves, driven by promises and expectations, not necessarily current cash profits from selling AI to the world.
That's the essence of synthetic growth in this context. The industry looks like it's exploding partly because the biggest players are validating each other's valuations through these interconnected deals.
But if you take away the optimism, the financial engineering, has the underlying AI market proven it can generate enough external profit to support all this yet?
That's the trillion-dollar question, isn't it? The system is running hot, but maybe on its own internally recycled, highly leveraged fuel for now.
Okay, so connecting this idea of synthetic growth to the bigger picture, this system seems to be baking in some huge vulnerabilities, right? Systemic risks.
Absolutely. Before it will understand the risks embedded in this structure, the sources basically group them into 5 major categories.
Let's go through them. First one.
The most obvious one, maybe. Bubble formation and overvaluation. The valuations we're seeing, they just scream comparisons to the Cisco-era bubble in 2000.
The numbers are just wild. Nvidia briefly topped $4.5 trillion market cap.
Trillion with a T.
Yeah.
And the total value locked up in these circular AI deals we've been talking about, it's already over $1 trillion in committed capital, equity swaps, warrants, etc.
$1 trillion circulating within the system. And is the actual profitable application of AI keeping pace with that valuation?
That's the concern. The monetization models for a lot of AI are still uncertain, still speculative in many cases. And look at the burn rate.
Yeah, you mentioned OpenAI earlier. The projection is...
Projections suggest OpenAI alone might burn through $115 billion by 2029.
Wow, $115 billion. How do you sustain that?
You can't, not without constantly bringing in massive new funding rounds or relying on these circular deals where your suppliers are also your investors, constantly recycling capital back into you. It needs the loop to keep spinning faster and faster.
Okay, risk number 2, you mentioned fragility.
Systemic fragility. Because of this intense interdependence, the AI ecosystem isn't just a bunch of separate companies anymore. It's like one giant, highly leveraged financial network. Everyone's balance sheet is tied to everyone else's.
Back to the speedboats tied together.
Exactly. One failure can cause a domino effect.
That's
Imagine OpenAI has a big delay releasing its next big model, maybe technical issues, maybe safety concerns.
Okay.
Suddenly, Nvidia's projected revenues from OpenAI take a hit. Their stock drops. That drags down AMD's stock because they're in the same sector and linked through their own deal. That hits the value of OpenAI's AMD warrants. Maybe Oracle's cloud business slows down because OpenAI isn't training as much.
It ripples through the whole system.
Catastrophically, potentially. And think about the physical side, too. Those 6GW and 10GW data center plans, they're based on these commitments. If a key player falters, the energy grid planning, the construction, it all gets thrown into chaos. The failure of one node threatens the whole network.
Okay, that's scary. What's the third risk?
Distorted market signals. This is crucial. When a company like OpenAI buys billions in chips, partly because doing so unlocks billions in equity value from AMD, is that purchase decision based purely on real, expected customer demand for their AI services.
Or is it influenced by the financial incentive of the deal itself?
Exactly. It decouples the buying decision from pure, unadulterated market signals. Investors, analysts, even the companies themselves might not have a clear picture of true underlying demand versus financially incentivized demand.
And the danger there is?
You overbuild. You
Yeah.
get way too many GPUs, you build way too much data center capacity based on these circular commitments rather than validated end-user needs.
Which sounds exactly like the dark fiber problem after the telecom crash in 2001.
Precisely. Billions spent laying fiber optic cable across the country, across oceans, and then huge amounts of it just sat there unused, dark, for years because the demand didn't materialize as fast as the hype predicted. We could be setting ourselves up for a dark silicon or dark data center glut.
Okay, risk number 4. This must be catching the eye of regulators.
You bet. Regulatory red flags are waving furiously. The scale, the concentration, the self-dealing nature of these loops, it's drawing serious attention.
Who's looking into it?
Sources say the FTC, Federal Trade Commission, and the DOJ, Department of Justice, are significantly increasing their scrutiny.
What are they worried about?
Well, think about it. The same few Magnificent Seven tech giants dominate the chip production, Nvidia, AMD, the cloud platforms, Microsoft, Amazon, Google. And they're the primary investors pumping money into the leading AI labs, OpenAI and Anthropic, who are also their biggest customers.
Yeah, it's a very cozy circle.
Regulators see potential conflicts of interest everywhere. They worry about extreme market concentration. Are these deals locking out smaller competitors? And they're concerned about the accounting opacity. All these complex cross-holdings, warrants, non-cash transactions, it can make it really hard to see the true financial health or understand competitive dynamics. Potential anti-competitive behavior is definitely on their radar.
All right, and the 5th risk, you mentioned physical limits.
Yeah, we can't ignore the real world. Operational and physical constraints. Even if the money makes sense on paper, can we actually build all this stuff as fast as the deals imply?
What are the main bottlenecks?
Power is a huge one. We're already seeing reports of power shortages or utilities struggling to keep up in major data center hubs like Northern Virginia, Texas, even Ireland. You can't just magically conjure 6 or 10 gigawatts of new, reliable power.
Takes time, permits, infrastructure.
Years, potentially. Then there's cooling. These AI data centers run incredibly hot. You need massive amounts of water or sophisticated cooling systems. Land near existing infrastructure hubs is getting scarce and expensive.
And you mentioned water specifically.
Yeah, the numbers are pretty stark.
Yeah.
Sources estimate each gigawatt of data center capacity can consume roughly 1 billion liters of water per year for cooling.
1 billion liters per gigawatt per year.
Now multiply that by the 16 gigawatts just from those big OpenAI deals with AMD and Nvidia we talked about.
That's 16 billion liters of water annually, just for those.
Roughly. In a world facing increasing water scarcity in many regions, that physical constraint becomes a massive operational and societal challenge. It's not just finance. It's physics and resource limits hitting up against ambition.
Okay, so hearing all this, the overvaluation fears, the systemic risk, the distorted signals, the regulatory heat, the physical limits, it really does feel like deja vu. We have seen this movie before, haven't we?
We really have. The parallels to the late 90s internet boom and the subsequent telecom bust are just impossible to ignore. Digging into the history is essential here.
Let's do a direct comparison. How does the AI hype today stack up against the dot-com hype back then?
Okay, let's break it down point by point, using what the sources highlight. First, the hype metrics. What were companies valued on back then?
Eyeballs, right? Page views, website visitors, anything suggesting future potential, not actual profit.
Exactly. Speculative proxies for future revenue. And today, AI companies are often valued on tokens, processed, model parameters, maybe FLOPS, and critically, the raw compute capacity they've secured through deals like the ones we discussed.
So similar idea, valuing potential and infrastructure over proven immediate profit.
Very similar psychology. Betting on the infrastructure build-out phase before the mass market revenue fully kicks in. Okay, second, infrastructure glut.
We mentioned the dark fiber, an estimated 80 million miles of fiber optic cable laid, much of it unused for years.
Right. Massive overbuilding based on hype. And today, We're seeing gigawatt-scale data centers being planned and built, often justified primarily by these large circular commitments from AI labs, potentially years ahead of validated broad market demand. Again, the risk of overbuilding is immense.
Then the vendor financing angle. This seems like the closest parallel.
It really is. Back then, you had companies like Lucent Technologies lending $8 billion directly to its own customers, often shaky telecom startups, specifically so they could buy Lucent's equipment.
Looked great on Lucent's books until those customers went bust and couldn't repay the loans.
Exactly. Write-offs were catastrophic. Now, compare that to today. Nvidia investing up to $100 billion in OpenAI, AMD giving massive warrants. It's the same concept, the supplier financially enabling the buyer.
But there's a key difference in the type of financing.
Crucial difference. The dot-com era primarily used debt and loans. When it blew up, it was about defaults and bad debt. Today's AI circularity is heavily based on equity and warrants.
So if things go bad, it's more about asset values collapsing, stock prices tanking, rather than outright loan defaults.
Generally, yes. The risk is shared differently, maybe more diffused through the stock market. But the core mechanic, creating demand through financial entanglement with the supplier, is strikingly similar. The illusion of organic growth is the common thread.
Okay, and finally, revenue models. How do they compare?
The dot-coms relied heavily on online advertising, which was new and unproven at scale, and lots of purely speculative startup ideas, vaporware, that never generated real cash flow.
Whereas AI today, the models seem a bit more solid.
Arguably, yes. AI is being integrated via software as a service, SaaS subscriptions, cloud platform usage fees, direct enterprise licenses, API calls. These are generating real revenue streams already, even if the scale doesn't yet justify the trillion-dollar valuations for everyone. There's more tangible utility being paid for now than the pure eyeball-chasing days.
So remembering the outcome of the dot-com crash, it was brutal. The NASDAQ fell 78%, something like $5 trillion in value vanished.
A massive wipeout. But, and this is important, the underlying idea of the internet wasn't wrong. It did change the world. The companies that survived, like Amazon and Google, eventually proved the thesis right. The crash was a correction of the financial excesses, not a failure of the core technology.
Which leads to the big question for today. Could this time be different? Are there factors now that might prevent a total meltdown like 2000, 2001, even if there's a correction?
That's the hope, and there are some compelling arguments, some buffers that exist today which weren't really there back then. The sources point to about 4 key mitigating factors.
Okay, what's the first one?
Cash-rich giants. This is huge. Unlike the often heavily indebted startups and telecoms of the late 90s, the main players driving the AI boom today, Microsoft, Google, Amazon, Nvidia, even Meta and Apple, are sitting on mountains of cash.
How much are we talking?
Collectively, the top AI-focused tech giants hold something like $380 billion in cash reserves.
$380 billion, that's a massive cushion.
It's an enormous financial shock absorber.
Yeah.
If the market turns, if valuations plummet, these companies have the resources to weather the storm. They can keep funding their AI divisions internally, maybe even acquire struggling AI startups on the cheap. They're not immediately dependent on fickle external capital markets like the dot-coms were. That provides significant stability.
Okay, that's a big difference. What's the second mitigating factor?
Tangible productivity gains. You touched on this. It's not just hype about future potential. Companies are actually using AI tools right now and seeing results.
Like what?
AI co-pilots, helping programmers write code faster. Sophisticated AI agents automating customer service or logistics. AI analyzing data for drug discovery or financial modeling. These are generating real, measurable efficiencies and enabling new capabilities for businesses.
So there are real use cases providing value today.
Yes. And that creates stickiness. When a company integrates AI deeply into its core operations and sees real benefits, it's much harder to just rip it out if the market gets shaky. It's not like canceling a speculative banner ad campaign in 1999. This suggests a more durable base of demand.
Okay, number 3. This one sounds counterintuitive. Physical scarcity.
Yeah, physical scarcity is a natural break. It's an interesting counterbalance. We talked about the constraints, the power shortages, the chip manufacturing limits, the land, the water.
How is that a good thing in this context?
Because it naturally limits how fast the industry can overinvest and overbuild. Unlike software, which could scale almost infinitely, or laying fiber, which was mostly limited by capital, you simply cannot build and power dozens of gigawatt-scale data centers instantly, no matter how much money you throw at it.
So the physical bottlenecks actually prevent the bubble from inflating too quickly. They act as a kind of speed bump on the hype cycle.
Exactly. It potentially prevents the absolute worst kind of parabolic, completely unchecked build-out frenzy that we saw with fiber optics. The physical world imposes a slower pace, which might allow demand to catch up more gradually.
Interesting. And the fourth factor, something about governments.
Public-private synergy.
Mm.
This is also quite different from 2000. Back then, the internet was largely seen as a commercial phenomenon. Today, AI is viewed by governments worldwide, the US, China, India, the EU, Japan, as a fundamental strategic technology.
Like electricity or semiconductors or national defense.
Precisely. It's seen as crucial for economic competitiveness and national security. As a result, governments are stepping in with significant public investment in AI research, infrastructure, and talent development. They're creating national AI strategies.
How does that help stabilize things?
It provides a foundational layer of demand and investment that isn't solely dependent on commercial hype cycles.
Yeah.
Government contracts, research grants, investments in national compute resources, they create a more stable floor, especially if commercial demand dips temporarily. It makes AI feel more like essential infrastructure and less like a purely speculative bet.
Okay, so putting all this together, the circular financing, the risks, the historical parallels, the potential buffers, it feels like we're witnessing something more than just another tech boom. It feels like a fundamental shift in how innovation gets funded at this scale.
I think that's right. The rise of this AI circular economy might signal a profound change in, well, the financial physics of strategic technology development.
A new financial physics, what does that mean in practice?
It means capital isn't just flowing linearly anymore,
Yeah.
from investors to companies to customers, generating profit that flows back to investors.
Right.
Instead, within these critical tech ecosystems, capital is starting to loop. It circulates tightly within the ecosystem, primarily between the key strategic players, the chip designers, the platform builders, the AI labs.
And this looping reinforces their dominance.
It reinforces their scale, their data advantages, their competitive moats. It becomes harder for outsiders to break in because they're not part of these massive self-funding loops.
And it changes how we measure value, doesn't it?
Fundamentally, in this new physics, the prime measure of value, at least in the growth phase, seems to be shifting away from traditional profit metrics like PE ratios based on current earnings
Toward what?
towards compute capacity.
Hmm.
The sheer raw ability to train and run the next generation of massive AI models seems to be the key value driver that justifies these enormous investments and valuations. Owning or controlling the compute is paramount.
And, as we saw with the AMD warrants, equity itself is becoming a form of currency.
Exactly. Not just representing ownership, but being actively traded for essential resources like chips or cloud access. Companies are literally paying for today's infrastructure with slices of their potential future value.
Which makes growth kind of self-referential.
Very much so. Success breeds success within the loop. OpenAI's progress justifies Nvidia's investment in stock price, which makes OpenAI's stake in AMD more valuable, which helps OpenAI secure more compute from Oracle, which buys more chips from Nvidia. It feeds on expectations and internal commitments, perhaps more than on immediate validated results from the external market.
So the ultimate question remains the same, just framed by this new physics. Is this truly a sustainable new way to fund groundbreaking tech, or is it just bubble mechanics 2.0 dressed up in fancy AI terms?
And the answer hinges entirely on one thing: productivity. Will this $1 trillion plus of circular capital expenditure actually translate into real, demonstrable, sustained economic productivity gains across the broader economy?
Or will we just end up with massive stockpiles of GPUs gathering dust in empty data centers, like the dark fiber of the past?
If the productivity truly materializes at scale, if AI genuinely revolutionizes industries and creates widespread economic value, then this intense leveraged financing structure will be seen, in hindsight, as a necessary, albeit risky, way to build the foundation.
But if it doesn't deliver on that promise soon enough,
Then the feedback spirals of contraction we talked about could kick in, and the whole thing could unravel pretty painfully.
So bringing it all back to that OpenAI AMD deal that started us off, it really is the perfect microcosm of this whole situation, isn't it?
It really is. It shows the sheer visionary scale, the industrial ambition, building infrastructure for potentially 6 gigawatts, but also embodies the incredible financial volatility, the leverage, the circular dependency.
It's this weird fusion of concrete industrial build-out and almost abstract financial engineering, pulling mechanisms from the riskiest market episodes of the past.
Yeah, and history's verdict on this whole era, it's still being written, obviously, but the outcomes seem pretty binary.
Scenario one.
Scenario 1. AI delivers. We get sustained breakthroughs, widespread adoption, real productivity gains across the board. If that happens, people will look back at this period at deals like OpenAI, AMD,
Yeah.
and say, wow, that was the necessary infrastructure boon before the age of abundance. The financial weirdness was just how they got it done.
Okay. In scenario 2.
Scenario 2, the returns lag. The monetization proves harder or slower or less impactful than hoped. The massive compute capacity built through these circular deals isn't fully utilized profitably.
Yeah.
If that happens.
Then it goes down in the books as the largest circular bubble since 2000. Just swapping silicon and equity for dark fiber and debt as the speculative asset. Human optimism and financial engineering running ahead of reality again.
Exactly. We started this whole deep dive talking about that vision, that prophesy almost, of an age of abundance. But think about how the foundation for that possible age is being built. Through this incredibly intense, circular, highly leveraged financial system that concentrates enormous power, hundreds of billions in capital, control over essential compute within a tiny handful of massive interconnected companies.
So the final thought we want to leave you, the listener, with is this. If this is the financial structure required to build the road to the age of abundance, what does this unprecedented concentration of financial and computational power locked within the circular system mean for who actually gets to control and benefit from that abundance when or if it finally arrives? Something to think about.